trading history, any lending. So maybe have a little chat about that.
Steve, you answer this one, but just before we go on, can we just get him off Birmingham Midshires? They've not been called Birmingham Midshires for years.
It just shows you how long. What is it? Just BM Solutions. BM Solutions. Hello and welcome to Inside Property and Finance Podcast, where we talk all things money and finance. And this episode, we're going to go into what does it mean when you're working with brokers when they've got access to the whole of the market. Mainly focusing on should you go to your high street lenders and deal with their brokers, or small independents, or bigger mortgage companies. And I'm here with my business partners. We've got Steve and Paul here. So we're going to go into that conversation and talk all things finance, and as usual, see where we go. So I think kicking things off, let's have a conversation around what whole of the market means, because it's a loose term that gets floated around. And I think off the back of the event that I was at last, just the weekend there at one of our Jumpstart events, I was surprised at how many people came up to us and was questioning about whole of market. Should I deal with the high street lenders, mortgage broker? And, I've dealt with a broker before, but they were limited with how many options are available. So I think let's unpack some of that so that those that are listening can start to understand their lending options.
Okay, so whole of market, you're right, it's a loose term completely. And some people think it means that you use every single lender out there, and by the time you've added residential, buy-to-let, bridge and development, that you're into hundreds of lenders. But no broker uses every single lender. There's some lenders you shouldn't be using, probably is the case. But actually you can class yourself as whole of market and only use 8, 9, 10, 12 lenders in entirety, even in the residential. What you have to do is you have to prove that you're representative of whole of the market to use the whole of market tag. But this is something that we believe strongly in terms of looking at our team and what gives them the quality edge on other brokers. And like last year we used over 50 lenders, and that's a lot. That is a lot for a broker. In fact, I'd be surprised if anyone used any more than that. So yeah, it can be something that brokers use in a very much a marketing sense to promote themselves. We are whole of market, but the question really should be, are you really? And that's probably where people say it's a loose term. But a good broker will use a lot of lenders, not just to make sure that people are getting the best terms and conditions, but also if someone's got a bit of a problem, the more lenders they'll look at and use, the more chance to have of finding a solution for that problem. So it's twofold: cost saving and problem solving.
Yeah. I mean, I had one guy over the weekend there, and I was just asking a question about certain things, and he says, well, I've got a problem with my mortgage broker. And I was like, okay, well, let me know. What's the problem? And he said that he told me that I'm growing too fast. And I asked him, how many properties you got? And he's like, 3. And I'm like, okay, well, I'm definitely not growing too fast, but respect, you've got 3 properties. But that's kind of weird to hear that from your broker. And I just asked, I says, well, is it an independent broker, or, tell me a bit more? It says, it's the mortgage broker for Bank of Scotland. And I was like, okay, so you're dealing directly with the Bank of Scotland, who can only offer their own products. They're not going to offer another bank's product, of course. So they're probably thinking that he's too leveraged with them based on their criteria. I think that there puts off a lot of people, because he was there genuinely concerned that he's got no further options. And because he's listening to a mortgage broker that just so happens to work for the bank. So maybe talk a little bit about that in terms of, going to the high street banks. They can only offer one product, dealing with an independent broker, or what?
Yeah, and that's a great point, that, Paul. He's at the mercy, really, of Bank of Scotland and their criteria. And it might be that Bank of Scotland only allow 3 buy-to-lets in the background. I don't know, because I don't deal with it day to day, but there are many lenders where they'll say you can only have 3 buy-to-let mortgages with us. And once you've exhausted that, then of course you can go to another one, TSB, get 3 with them, or Birmingham Midshires, or whoever, get 3 with them. But there's also lenders that will go up to 10, and there's lenders that will have no limit on how many you can have. So it's just down to, the way I read that is, it's down to their risk appetite, and they're just seeing that with them that's quite risky, and he might have got 3 in quick succession. So and just going back to the point Paul made before about lender spread, there's hundreds of lenders out there, and there's about 90 in the resi and buy-to-let market, the term market, if you like, the longer-term market, of which we used 54 last year, didn't we? But there's hundreds of bridging lenders, development lenders, and you might only use a fraction of those. So there's all sorts of options, all sorts of criteria, and every lender's risk appetite's a little bit different. So I would, straight away, if I was in that guy's shoes, I would then be speaking to a broker who uses the whole market or can potentially use the whole market and just say, this is what Bank of Scotland have said. How would you respond to this? And get their take on it.
Yeah. Now, I've worked with many brokers, lots of brokers in my time. And of course, I've came on board as, part of Express Mortgages with you guys. And we're obviously a bigger outfit with a lot more brokers than maybe a small independent, like how you guys started off many years ago. And I'm all for the small independent. I'm all for small businesses. I'm all for someone starting out, being entrepreneurial, learning their trade and grafting. But I'm also for the investor, the developer, someone who needs to get the best finance terms, someone that needs a broker that can be proactive, that can speak to other options and other lenders for them. Because sometimes I've had this experience myself, and I see it a lot with many others too, is if they're speaking with a small independent, and it's not that they're limited, it's just that they can only think with a handful of lenders for their clients because they've got so much to do. They're almost trying to spin so many plates themselves to grow their business, and maybe they've got an assistant or maybe bringing on one other broker. So we all need to go through those growing pains as such to grow as a business, to be able to give a better service to a lot of clients. And especially if you're bringing on more clients, the challenge then comes that are you giving them the best rates? And what tends to happen, I see it a lot, is that someone's looking to get a certain mortgage and maybe they can't get a mortgage because with the 3 lenders that the broker goes to, and the broker's like, yeah, it's too much work for me to then go and try and fight their case to find another lender and, to get that mortgage. And hence why Express, I see it a lot, that we end up picking up a lot of those investors who thought could get no options with lending, and lo and behold, what happens? They're getting access to funding.
Yeah, when you think about going back to the Bank of Scotland example, touching on what you're coming to there, really the guy's saying to the client, you're growing too quick. In reality, what he should be saying, the honest answer is, we can't grow as quick as you want to grow with you. Our limitations are your limitations. And it does go, and that's when you are limited to that one lender's criteria. I'd hate to be a tied advisor. They're not mortgage brokers, they're mortgage advisors. Probably very good, but they're limited, aren't they? And then similarly, when you get to broker status, when you can, if you wish, spread your net very, very wide, it takes hard work and effort, and those growing pains that you allude to, I think fortunately now we've gone through them, haven't we? So, we've got the team who does the resis, team who do the buy-to-lets, team who does the bridging and development. So they can be tip-top and they can spread the net wider because they're just put in a pool of clients that they're constantly doing the same kind of advice to, because we don't let them all do all things and sundry for the quality of advice reason. So we have a lot of clients who, they've maybe been tied up with the bank, they've been to other brokers, and it's almost astonishing to them when you say, what you on about, you're limited, you're growing too quick, things like that. You've run out of options. We've got landlords with 100, 200, 300 houses on the books. They've not done that with 3 mortgages. No chance. So it's just knowing, again, which rocks to look under to get the best terms and conditions for the client in front of you.
Yeah, I remember starting out my own property journey, and many people have heard the story. I was only able to get my first mortgage in my own personal name, my first buy-to-let, which was with Birmingham Midshires, until I'd messed up my credit with struggling to pay back loans and credit cards when I was investing in my education when I was a young whippersnapper in my late teens, early 20s. So for me, I then started to work with others to joint venture, because my mindset was I'd rather have 50% of something than 100% of nothing. So I would go to different people, of which you guys know Richard Swan is one of my partners, and he would get the mortgage in his own name. And it was around that time, this is probably 2011, 12, where we were growing very quickly. But the problem is Birmingham Midshires, which tend to be quite a good lender, to be honest, when it comes to personal buy-to-lets. At the time, you could get up to 9, and already I had no chance because I couldn't get any more mortgages with them. But we were starting to get mortgages in Richard's name, then our other friend's name is Barry, then Ian's name, and then before you know it, they changed it, and it was the whole HBOS group. You're not allowed 3. So that there shrunk it again, and then we're like getting mortgages in their partner names and everything else. The point I'm going here is that even though that person who thinks that he's grown too fast with the Bank of Scotland, that is personal lending and buy-to-lets in his own name as well. And then as we know, and this is just something, it's not recent, but over the last number of years, where it's more advantageous, potentially, to purchase within a limited company. And that opens up different lending as well. There's a misconception here, and I'd like you guys just to maybe talk about it, and I hear this a lot, and I get it. No lender's going to give a brand new company that's just set up with no trading history any lending. So maybe have a little chat about that.
Steve, you answer this one, but just before we go on, can we just get him off Birmingham Midshires? They've not been called Birmingham Midshires for years.
It just shows you how long. What is it? Just BM Solutions. BM Solutions.
So you're showing your age. You're showing your age.
Of course I know it's BM Solutions, but I don't know why. I think it's just because I'm so attached to my first ever mortgage. You know?
Oh, brilliant. Yeah. Go on, day one lending.
Limited company comes up quite a lot, that. So because normally when you go for a mortgage, like on your main residence, the lender requires 2 or 3 years accounts, don't they?
Yeah.
And people think if you're self-employed or you've got a limited company, you need 2 or 3 years accounts. But when it's an investment property and you set up a special purpose vehicle, limited company, you can get lending the same day. So you don't need to have 2 years. Lenders are more interested in the individual as such. So they will look at their credit history. They'll look at if they are self-employed, what do they do? How long have they been doing it? That kind of thing. But the actual entity that the asset's going to be within, they're not bothered if that's set up the same day.
And then with a limited company, let's say you get a limited company, ABC Limited, and it goes and purchases a property and it gets lending against that asset. That lender is tied to that asset that's lent against that one.
Yeah.
And let's say they go and buy another property within the same limited company. It might not be the same lender, is that right?
Yeah.
So it could be another lender,
different lender.
and they're lending. Yeah. So just to clarify that, because it's a question I get so often, and maybe some of our listeners or those that are watching are maybe thinking the same as well, because finance is like a lot of different moving parts. And one thing that I know myself as well is criteria constantly changes, doesn't it?
Yep.
Depending on what's happening in the market, depending on what's going on with the Bank of England base rate as well. Just one thing I want to touch on that, because it's a common thing that's going on just now in terms of interest rates, and more importantly, what does that actually mean? And if the Bank of England base rate is going up, does that mean that all lenders' rates are going to go up? Does it mean it's going to be more expensive? Just a kind of general conversation around that.
Go on.
Do you want me to kick on? So, yeah, well, actually, it's very, very topical at the moment because the Bank of England have put rates up. Is it 14 times on the trot now? 14 or 15, I think it's 14. And HSBC, Halifax, there's a few of them that have been in the press recently that have brought their interest rates down, their mortgage rates down. So the Bank of England may well put rates up and lenders may bring rates down, because when they were going through a cycle of putting rates up, and I think it was when they hiked them up 0.5%, there was a bit of a panic in the market and swap rates were at one level, weren't they? And so lenders reacted to that and put rates up, their own rates up, noticeably higher than 0.5%. So when things then settle down, the banks thought, actually, now swap rates have come down, we'll bring ours down in line. And so their own interest rates on 2-year fixed, 5-year fixed or whatever, started to head back downwards.
Yeah, you've got to, first of all, it depends on the type of rate, doesn't it? So if you're in a mortgage, you're on a tracker rate, the base rate goes up, your mortgage is going to go up because it's linked directly to the base rate, yeah? In terms of new mortgage, well, an existing fixed rate isn't going to be altered, but in terms of what you can acquire going forwards, the banks are looking really at, and this is what Steve's alluding to with swap rates, it's what they think is going to happen in the future. So not so long ago, a lot of people were thinking the base rate's going to hit mid-6s, maybe even 7%. So the fixed rates were going up because the swap rates were going up, priced against it getting that high. And then we've seen inflation soften quite dramatically all of a sudden after being quite sticky. And therefore, we've now got the markets believing that the base rate will only go up to maybe 5.5, 5.75. So let's just say maybe 1% less than what they did expect just a few weeks ago. So all of a sudden, those swap rates get repriced against the fact that they no longer think it's going to go as high. So you can have a base rate going up and fixed rates coming down. And it does confuse people that at times. You know, many of our clients and seasoned investors still don't maybe get the head around it. And I think the danger is, and I've done a couple of posts on this, people start to procrastinate. They start to think, "What? I'll wait. But, you know, procrastination is the thief of time, as the saying goes, and time is money. And, you know, we have a simple message. If it's in terms of you've got a mortgage coming up for renewal, just grab hold of something, because there's already stuff in the press this morning about inflation might go back up again in August, and maybe that'll change the trend again. So get something under your belt, keep an eye on it between now and when your deal's really up, and not one day before it's up, because that's not enough time, but maybe in the last month or so, reassess again and see if you want to move your deal before it's too late. And I think that's why a lot of people become hesitant about doing things. And ultimately, we're going to be in this kind of a rate environment for quite a while. So the questions are, I suppose, from the first time buyer, do you want to live with mum and dad for another 2 or 3 years, or do you want to get out of there? Do you want to go and rent somewhere? And rents are flying up. You've just got to make a decision and go with it, and apply it to your own circumstances. And I know that's going a little bit away from what we're talking about, but I just thought it's a bit of an important message that to get to people, whether it's first-time buyers, investors, sitting doing nothing because rates might do this or might do that doesn't get you anywhere.
Yeah, you've got to be proactive. I mean, what's the point? Is it just to sit back and wait for the markets to try and stabilise? And I think that if you look at that, history tells you that when the market starts to stabilise, you've now got far too much competition. Now you've got, you know, you thought you were going to be waiting for the right time and go in and swoop in and get the best deals. But no, the seasoned pros are already cleaning up. It's one of those ones that I always say this, is that you don't have a property business if it's cycle dependent. You know, imagine, this is for every business. Imagine you've got a property business, right? As we do. And it's like, okay, so I can't work this month because the rates are doing this. I can't go out and find any deals. I might as well just not do anything. You know, I might not do anything for the next 6 months. Well, that's never going to be, you know, a viable solution. And I get it. Some people are full-time in their own business, or they're employed and, you know, and adding to their portfolio as and when. But no, you know, time waits for no one. You know, you've got to be proactive. And I think people are so spoiled because interest rates up until the last year have been so low for, in my opinion, for far too long. And I think that rates were probably held a lot lower because of everything that happened with, you know, the global health crisis, with all the lockdowns, and, you know, and that probably kept interest rates low for much longer than it should have been. So, I mean, interest rates, I remember, were at this level when I first started getting involved in property in, you know, 2008, 9 at that time, you know. So it's just funny that people think that rates at this level at the moment are expensive. But I remember rent on my little 2-bed flat that I've got here that I rent out. I remember when I bought that, I was collecting 425 rent on that. And the interest rate that I first got that was 5.5%. And then fast forward to now, I'm now getting 6.75 on that one. So it just shows you that, and it's the same rate. In fact, I've got better rates now since I refinanced. But the difference is, though, is that, you know, the rates are kind of been similar, even though there was a period where they were low, but rent keeps on going up. So it's one of those ones that, of course, you've got to make sure that you're buying, you've got the right rental cover, and it's going to make you cash flow, but having that longer term view as well.
Absolutely.
Yeah, for sure. People have just got used to record low interest rates, haven't they? Like for a good decade. And I come back to two things. If you buy right, if you're always buying at the right price, whether that's below market value, discount to the market, and you're adding value, then it doesn't really matter because you're beating the market there anyway. It's based on how you buy it, isn't it? What you pay for something.
Absolutely.
Well, simple things as well, and you see it from seasoned investors when they're coming to us with projects. So if the market's fairly settled or rising, they look at a GDV, they work with that GDV, gross development value, for those people who don't know, what it's going to be worth when they've done the project. But when it's a bit more of a market like today, where maybe prices are falling 2 or 3%, 5%, 8%, 10%, depends who you're listening to, what they think's going to happen. Your seasoned investor doesn't sit there and go, I can't work. You know, back to what you're saying, I can't work for a month. They just go, right, okay, so my GDV's £1 million. I think the market's going to soften 5%. I'm going to work to a 950 GDV. Or the market, I think, might go down 10%. I'm going to work to a 900 GDV because that project's going to take me a year to do. They just build it into the operation that's the GDV, the build cost of this, and therefore the price I'm prepared to pay is no longer what it was 12 months ago. It's now this. But they don't stop themselves working, and it's madness, isn't it, when people shut up shop. I mean, imagine if a mechanic said, oh, I can't fix your car because the price of the oil you have to put back in is a bit higher than it was last week. Or, you know, I'm not going to turn up to the bakery today and bake bread and stuff because the flour's a bit more than what it was. You can imagine that just for a minute. The whole world would find our reason, wouldn't it? And we'd all just be like sitting in our lounges, twiddling our thumbs all the time. But for some reason, property seems to suffer more with that way of thinking. And it's really, especially if you're a property investor and that's your business, it's a ludicrous thing. And just to finish off on it again, I always go back to our time-served investors and what are they doing. And they're all rubbing their hands right now. Yeah. And obviously I won't name any names, but, you know, just one last week, we are going to make a fortune in this market. And so they're seeing it as like the Christmas is coming because uncertainty breeds deals for them.
Yeah, that's the thing. It's market sentiment as well, even though the reality is that we've avoided recession and it looks like inflation will start coming under control, and it looks like 2024 will look like another year of growth across the board, especially within the property sector as well. So even though we know that is forecasted, unfortunately, what we're hearing in the mainstream media is the exact opposite. It's still very much doom and gloom, disaster. You know, it's going to be the end of the world. That's kind of how they make it, right? Clickbait headlines to try and draw in people's attention. Yep. And the seasoned investor, they play to market sentiment. So when they're negotiating, because I've seen this, I've seen so many people within our Protege community, I'm just talking about the last few weeks, where they've put an offer in and they were the third highest offer. And then the deal's fallen through with someone who's maybe overpaid to get it. And the first and second in line have now pulled out and it falls back to the investor. And they of them went, okay, well, I know I was third in line, third best offer, but I'm no longer offering that. I'm actually going to offer this, even less, and getting the deals. And that's because they're playing to market sentiment. You know, and the reality is the person who had the deal fall through, they've taken that offer that was probably a time that if it was a year past, it would have been great and it would have happened. And I think that now what's happening in market sentiment that I'm starting to see here is that as much as there's still property selling over market value, I think there's less of that at the moment. And I think we're going to see that come back down before we start seeing things move again. And for the seasoned investors, they're playing to that advantage. They're using that as market sentiment. Anytime they see property on the market for more than 2 months, sticking a little bit longer, you know, I think sellers are starting to realise, oh, hold on a minute, I'm not getting the big offers that was once there. We better probably think about, do I want to move? Do I want to lose out my next home? And should I be selling now before the market comes down? And investors are swooping in and using that to their advantage.
Yeah, a couple of patterns I've noticed, Paul, recently is that people with the houses up for sale that normally would go quite quickly, suddenly I'm seeing as I'm going for my run around the local neighbourhood, to let is coming up on houses that aren't typical buy-to-let properties. And also speaking to developers, there's one in particular that's saying to me, I couldn't get hold of my agents last year or 12 months ago. Now they're phoning me. So there's a change there. So the developers I'm speaking to are quite cheerfully optimistic about this next period.
I'm going to just mention one thing about a developer who will remain unnamed here. and it just shows you what's happening in the market. It's fascinating. So there's a specific developer, smaller developer, although he's got a big outfit in terms of his construction team, and he's laying off people just now. And I asked him, I said, well, why do you think the market's going to be very different? He says, Paul, I'm using this opportunity to get rid of dead weight.
Yeah.
Because if the market's buoyant and things are happening, it's more difficult for me to let people go.
Yeah.
But I can use what's happening right now to get rid of people that they will turn around and not blame him. They'll blame what's going on in the economy and stuff. And I thought, what do we think? That's cheeky, but at the same time, I'm like, genius. You know, it gets rid of dead weight, using what's happening and not having, and he's just literally cutting dead weight. So it's interesting. Yeah. So I think with that in mind, this has been a great podcast, just talking all things and going on to different tangents as we always do. But as always, make sure you're subscribed to the channel, and we do read your comments. So pop any comments you've got. What's your thoughts on the market, and what's your thoughts on dealing with brokers as well? And if you pop it in on the chat box down below in the comments, we'll be sure to go in there and respond. And of course, if you're looking for development finance, you're looking for buy-to-let mortgages, residential mortgages, all things finance, head over to expressmortgages.co.uk. And of course, our team will look after you. So all the best, and bye for now.